Welcome to the deep dive. We're here to cut through the noise, zero in on those key insights you need. You know, the business world moves incredibly fast.
It's really that.
So quickly getting those essential bits of information, that can make all the difference.
Absolutely.
Today, we're doing just that. A focused look at Arvind Ltd's Q1 FY26 financial results. That's for the quarter ending June 30, 2025.
Right. And our mission here for this deep dive is really to unpack what these latest numbers tell us about Arvind's performance, their strategy, what the future might hold. We want to help you, the listener, get up to speed quickly on this important development without getting bogged down.
Exactly. And to do that, we've pulled together quite a stack of sources. We've got the official financial reports. There's an independent auditor's review. That's from Deloitte Haskins & Sells, LLP.
Okay.
Plus the company's own investor presentation and their press release. So it's a pretty comprehensive picture we're looking at.
It is. It's quite a lot to piece together.
So let's get into it.
All right. So the big picture first. Arvind Ltd's Q1 for fiscal 26. The consolidated highlights, they definitely stand out. Total consolidated revenue was 2,006 crores.
2006 crores. And how does that compare?
Well, that's a 10% year-on-year growth. So compared to 1,831 crores in Q1 of FY25.
Okay, 10% revenue growth. That's a solid start, yeah. What about the profit side?
Good question. Consolidated EBITDA, that's earnings before interest, taxes, depreciation, and amortization, hit 186 crores.
Right.
That's up 14% year-on-year from 163 crores last year.
And the margin, did that improve too?
It did, yeah. The EBITDA margin reached 9.3%. That's a 40 basis point improvement from 8.9% in Q1 FY25. So definitely a positive signal there.
A positive signal indeed.
And maybe even more striking, the profit after tax, the PT, that came in at 53 crores.
53. Wow. How does that compare, YoY?
It's a big jump, a 35% year-on-year growth from 39 crores.
35%. Okay.
But, while those numbers look really good on the surface,
It's always a but.
there's always context, right? The company itself points out that comparing directly to Q1 FY25 is a bit tricky. Apparently, last year was a softer base. They had some industrial disruptions. Plus, this current quarter, Q1 FY26, it faced these new U.S. tariff effects.
Right. The tariffs.
So Arvind's saying, look, each quarter has its own dynamics. You kind of need to view it in its own context.
That's really crucial context. It makes you think how much is like genuine forward momentum versus just bouncing back from a weaker period.
Exactly.
Especially with those U.S. tariffs now in the mix. So, all right, despite those sort of external headwinds, what actually drove this positive performance? What went right?
Yeah, that's where it gets quite interesting because they reported steady volume growth across all their business segments.
All of them, even with the tariff worries.
Apparently so, which is pretty impressive. But the real standout was the garmenting division.
Ah, garmenting. Yes, I saw that. A stellar quarter, right? Highest ever quarterly revenue.
Highest ever, 485 crores. That's an 18% growth.
18%.
And get this, they produced almost 10 million pieces, like 9.8 million full garments.
Wow. And that wasn't a one-off.
No, apparently they've been hitting over 9 million pieces consistently for the last 6 quarters now.
Okay, so real consistency there. What's fueling that?
They put it down mainly to winning new customers and also having a good product mix, a favorable one.
Makes sense?
And the outlook seems decent too. They've got a strong order book for Q2, so seems like that momentum might just continue.
Okay, good for garmenting. What about the other core areas?
Well, their core textile businesses also saw pretty robust volume increases. Denim volumes were up 9%.
Okay.
And woven volumes grew 8%.
Right. So even the traditional textile side is growing despite pressures.
Yeah. And then you've got the Advanced Materials division, AMD. That saw 16% volume growth.
16%. That's significant. And wasn't there a big contract win mentioned there?
Yes, exactly. A major achievement. They secured this large order, roughly 200 crores. It's for the Vande Bharat mass transport program to be executed over the next 5 years.
That's a big long-term win.
Definitely. And on top of all that, the companies also launched these initiatives, for margin protection and cutting overheads.
Ah, trying to shore things up internally.
Yeah, though they expect the main benefits from those to really show up more in the second half of the fiscal year.
So planning ahead. Sounds like a company playing offense and defense simultaneously.
That's a good way to put it because, while there were definitely positives, we also need to talk about the challenges, the things that held them back a bit.
Right. There was margin pressure mentioned?
Yes. Higher air freight costs and some additional discounting. And both were apparently direct responses to those new U.S. tariffs.
Ah, the tariffs again. So they're having a real tangible impact on costs.
Absolutely. Which then raises the question, how did these external factors hit growth in specific areas, not just the margins?
Yeah, good point. My first guess would be the Advanced Materials Division, AMD. That seems quite export focused. Did the tariffs hit them hardest on the growth side?
You're spot on. Growth in AMD was constrained. They mentioned deferrals of defense orders
Okay.
and also a pause in procurement for composite projects.
Yeah.
And yeah, that was linked back to tariff issues.
Right. So canceled or delayed orders because of the uncertainty.
Seems like it. And then on the textile side, the woven segment, its growth could have been higher too.
Why is that?
They cited higher absenteeism and also just described it as a lean season for that segment.
Okay. So a mix of external pressures and maybe some internal or seasonal factors.
Exactly. So overall, Q1 really does reflect this broader impact, doesn't it? Shifting sourcing strategies because of the tariff, plus these industry-wide cost pressures.
Yeah, it really highlights how companies like Arvind need that two-step approach you mentioned, celebrating the wins while actively citing these new cost battles.
Precisely.
Okay, so those top-line numbers give us the overview. But the real story is often in the segments, right? How did each division actually perform? Let's zoom in there.
Sounds good. Let's start with textiles.
Okay.
They brought in revenue of 1,536 crores. That's up 14%.
14% growth in textiles. Nice. And EBITDA?
EBITDA for textiles was 130 crores. That works out to an 8.4% margin.
8.4%. Got it. And the volumes?
Volume-wise, denim fabric hit 13 million meters, and woven fabric achieved 29 million meters.
Those are some big numbers. The sources seem to credit their vertical integration strategy here.
They did. They said it helped them increase their sort of wallet share with key clients.
Ah, getting more business from existing big customers.
Right. Plus winning new customers and diversifying the product range.
Makes sense. Though I think the sources also mentioned something about the price realization gains, that they might be temporary.
Yeah, they call them transient, which does suggest, they might not be counting on those higher prices sticking around long term.
Good caveat. Okay, what about Advanced Materials, AMD?
Right, AMD. Revenue there was 351 crores. That's a 7% growth.
7%.
Okay.
And the margins?
EBITDA was 45 crores. The margin came in at 12.9%, which is actually a slight dip from Q1 last year, which was 13.9%.
Okay. So volume grew, but margins slipped a bit. Why was that?
Well, the company explained it as, despite the volume growth, they had an adverse product mix. And also those higher customer discounts we mentioned earlier, likely tariff-related.
The discounts biting into the margin.
Exactly. But here's an interesting point they made. They reckon if you normalized for the impact of tariffs...
Like took out the extra air freight for quick orders and stuff?
Yeah, exactly. They estimate the AMD margin would actually be closer to 15%.
15%. Okay, that really does change the picture for AMD, shows underlying strength masked by these external pressures.
It really does. And apparently AMD has a strong Q2 order book lined up and a good pipeline from export customers too.
So the future looks brighter there, perhaps.
Potentially. And within AMD, the industrial segment specifically showed strong volumes and better capacity use. So underlying health seems pretty good despite the headwinds.
Okay. And just quickly, the other segments?
Yeah, those were less positive. Their combined revenue actually declined, dropped to 119 crores from 152 crores last year.
Oh, okay.
And EBITDA was down to 11 crores compared to 18 crores. So definitely a bit of a mixed bag across the board.
A mixed bag indeed. Okay, let's quickly touch on financial health, debt, and investment plans.
Right. So overall debt did increase temporarily, but about 181 crores.
Why was that?
They attributed to an increase in working capital needs.
Okay. So financing the day-to-day operations and growth. What about long-term debt?
Long-term debt currently stands at 374 crores.
Got it. And are they still investing? CapEx plans?
Yep. Full steam ahead on that front, it seems. All their ongoing capital expenditure programs are apparently on track.
And how much are they planning to spend this year?
They expect to invest somewhere between 450 crores and 475 crores for the whole fiscal year, FY26.
That's a fair bit.
It is. It's aimed at expanding capacity and supporting that long-term growth they're aiming for. So definitely investing through the current challenges.
Right, playing the long game.
Seems like it. And speaking of internal focus, there was also a key appointment announced.
Oh, yes.
Mr. Jigar Patel. He's been appointed as the company's internal auditor effective July 29th, 2025.
Jigar Patel. Okay. What's his background?
Pretty impressive, actually. He's a chartered accountant, master of commerce, got over 15 years of experience in internal audit, risk management, compliance, internal controls, the whole package.
Sounds very experienced. Where's he coming from?
He's held leadership roles at KPMG India, BDO India, and also at Gujarati Processors and Packers. You probably know them as Wal Bakri Tea Group.
Ah, Wavakre. Okay, so he's got experience across different sectors. Given that background, especially in governance and risk, what does this appointment signal, particularly with Arvind talking about that second half acceleration?
That's a great question. I think it signals quite a lot, actually. Bringing in someone with his depth of experience, across FMCG, retail, manufacturing, even oil and gas, and his track record with things like SAP implementation, setting up delegation frameworks, it suggests a really strong push to tighten up internal processes and controls. Feels like more than just a compliance checkbox hire.
So maybe ensuring the foundations are really solid as they aim for that growth and margin expansion later in the year.
Exactly. Especially in this, pretty dynamic global environment. It's about making sure the internal house is in perfect order before you accelerate too much, building that robust foundation.
That makes a lot of sense strategically. Okay, so with that stronger foundation hopefully in place, what does the road ahead look like, the outlook for Q2 and beyond?
Well, on the macro level, it's still a bit uncertain, especially with global trade. The U.S. situation, ongoing trade talks, that keeps things unpredictable.
Right.
However, there's a potential positive. The newly signed UK-India Free Trade Agreement. That's expected to potentially shift some sourcing towards India. Could create new export opportunities.
Ah, interesting. A potential silver lining on the trade front. What about domestically?
Domestically, things look a bit more positive. The Indian textile and apparel market seems to be recovering. They saw about 8% growth in June.
Oh, okay.
And with an early festive season expected this year, the hope is that momentum will continue.
So, global caution, but maybe some domestic optimism. How does Arvind see things from their own perspective?
Well, they're seeing strong momentum in the order books for both textiles and AMD. They feel this signals growing global interest in India as a place to source from.
Which ties into that free trade agreement point, maybe?
Could be. And specifically for garments, they're projecting volume growth of around 14% to 17% for the full fiscal year 26.
14 to 17% for garments. That's ambitious. What's driving that confidence?
They put it down to deeper engagement with customers and having expanded their capabilities.
Okay, and this connects back to that second half acceleration idea, right?
Absolutely. The company is really anticipating that pickup in H2. They expect both garment and AMD segments to achieve double-digit growth and margin expansion in the second half.
Double-digit growth and margin expansion. That's quite the forecast.
It is. And crucially, remember those deferred defense and high-value projects in AMD.
Yes, the ones held up by tariffs.
Exactly. They expect those key programs to revive in the second half as well.
Okay, so they're really banking on a strong rebound across the board later in the year?
They definitely are. So, despite acknowledging the margin pressures they expect in this first half, they seem pretty confident about H2. They're leaning on solid volume commitments they already have, plus those operational efficiencies kicking in, and just solid strategic execution.
Right.
So if we were to summarize this whole deep dive into Arvind's Q1 FY26, what are the key takeaways?
Well, it really seems to show a company demonstrating resilience, doesn't it? And some pretty smart strategic moves in the face of a really complex global economic picture.
Yeah, I agree. They're navigating headwinds while setting the stage for what they hope will be a much stronger second half.
It really highlights that need to adapt, balance the short-term challenges with those long-term investments.
Definitely.
Which leaves us with a thought, maybe for you, the listener, to consider. As these global supply chains keep shifting and realigning, how much will a company's ability to adapt swiftly to new trade policies, tariffs one minute, free trade agreements the next, how much will that, combined with internal strengths like their vertical integration or diverse products, become the real differentiator, the key to sustainable growth in the future?
That's a great question. That agility combined with inherent strength, could that be the winning formula?
Definitely something to mull over.